There's a common misconception that SMSFs are heavily invested in residential property when allocations to commercial property are actually higher. Joining me today is Jonathan Street from Think Tank to discuss the merits of investing in commercial property. Welcome, Jonathan.
Thanks, Darren. Good to be here.
Let's start with what you're seeing. I think recently you said that you've seen an increase in investment in commercial property from SMSFs. What do you put that down to?
There's probably a number of causes for that, Darren, that range across direct investment in commercial property to fractionalised investment. So there's a number of a great deal more investment products that SMSF members can choose from these days, and also the debt side. So we're seeing a lot more of the activity in the first part where people are borrowing, they have an existing business, they're locating their business in that self-managed super fund and they're taking a loan out against it. They're also much more informed about the products available in the indirect space, so they're attracted to the fixed income returns that commercial property can offer, and the debt returns too, where financiers are providing finance for commercial property owners, all the way from very small units, might be $100,000, $200,000, all the way up to the multi-million-dollar office blocks and big box centres and shopping centres and so forth. So there's a greater awareness all round, and I guess SMSF trustees are certainly going down that path of exploring the opportunities there, and they're really liking what they see in terms of the returns.
Yeah, yeah. There's also a conception that residential property is this fantastic asset class that will never let you down, and it's so robust that you have to be in it. Look, what worrying trends are there in residential property, and how can potentially commercial property investment address some of those issues?
Yeah, look, it is the question of the moment, and it will be for the foreseeable future, I think. In our view, there are certainly some concerns around residential property, but all in all, if you take a broader view, the actual retracement in values around particularly the metro areas, Sydney and Melbourne, is a healthy thing. We're of the view that if they continue to incline the way they had, then we'd be headed for a bigger problem. So the retracement of 5-10% in value at the moment is probably a good thing. It also helps affordability, and it evens the market out, and it'll settle down at some stage and return its incline. I think where the issues tend to distill at the moment are more around the construction areas. So we've had a very long run now of a construction boom. A lot of houses, particularly a lot of apartments, inner city apartments, they're the centres that really need some very careful consideration before there's further investment ploughed into those. There's a little bit of a retracement at the moment in terms of activity levelling off. Certainly developers are responding to a softer market, and we can see that in the headlines. But beyond that, the residential market remains pretty resilient and strong, and offers, I suppose, particularly for owner-occupiers, the same sort of proposition it has through generations. And investors, well, they're stepping away from the moment until they see values come back, but they'll be back in the market soon enough. By comparison, commercial property tends to be a lot more stable, certainly in our part of the market. At the top end, you do see some volatility, but where we operate in the area up to sort of $3 million, it tends to be a very stable and predictable part of the market. Yep. That's a good alternative in current and near-term future, in our view, for investors.
We've just discussed the return characteristics of commercial property and residential property for that matter. But are there any other advantages that an allocation to commercial property can provide?
Certainly, we believe there are a number of positives that attract SMSF trustees in particular. Certainly by comparison to, say, equities, which is quite high maintenance in terms of monitoring portfolios, individual stocks, reacting to headlines and so forth. There's a lot less volatility when it comes to commercial property investment, and as a consequence it requires a lot less maintenance. Certainly it takes an education process to make sure that investors are knowing what they're getting into. But by the same token, once they're happy with what they're seeing and what they're potentially taking on board, they can adopt a much longer term set and forget type approach. Doesn't need as much active day-to-day or month-to-month maintenance, and that sort of fixed income return that continues to deliver on a monthly or quarterly basis is an attractive feature as well that people often like, as opposed to waiting for 6 monthly dividends or a dividend that might get cut, or the actual underlying performance of a business. So there's equally, in terms of capital stability in commercial property, it's a lot more predictable in that regard. Tradable instruments such as hybrids, for example, have, through stable times of economic progress that we're sort of seeing at the moment, of modest to around trend GDP growth, and the financial sector, albeit with royal commissions and so forth in the background, banks are still performing reasonably well. Nobody's really concerned about hybrids, but they have quite considerable potential for volatility in capital value, and that is far less of a factor in commercial property.
Yep. So in the future, are you expecting to see a continued increase in allocation to commercial property from the SMSF sector?
Oh, absolutely, and that's not just us talking our own book. I think what we've observed over decades of being in the industry is that commercial property holdings have been a traditional means of wealth accumulation for a large part of the wealthier sector of the community, and the accessibility to commercial property investment now has been opening as people have become more aware of the opportunities. There are more products coming to market. The ability to invest in the sector has a much more open playing field for investors to choose from. And just with the natural accumulation of the national investment and holdings in superannuation, which is continuing to grow and compound year on year, people need to diversify where they're placing their portfolios, and commercial property is a natural diversification play. So we wouldn't advocate that people invest in commercial property. It forms a discrete part of an overall investment strategy, but it can contribute very good capital stable investments with good regular return income that you can get good visibility on.
Yep. Any discussion about property is often intermingled with attitudes towards limited recourse borrowing arrangements, and obviously there's a question mark over those.
Sure.
With an impending election coming in next year and potentially a change in government. You've recently expressed a view that you think it's a bad idea to actually ban these arrangements outright. Why is that?
Well, yes, I have been on record as making those statements, and I just preface my response there by saying that there's two streams of SMSF LRBA lending. One is on residential property, and one is on commercial property. So we're less supportive of the residential side. We don't necessarily see a cause for it to be banned, but we certainly see a need for greater regulation of prudent lending practices coming into that sector. On the commercial side, the whole proposition around having a commercial property in a self-managed super fund, the owners of the business being members of the fund, occupying it, and the business paying rent back to the fund, stands up on a much more independent basis for return profile of an investable asset that yields a return. And so the whole structure is much more self-supporting, and it's there for the long term. And the way in which it allows the owners of the property to have stability around their premises, predictability of rent, and control over all of their arrangements, building towards a long-term wealth management plan. And we see this with around 20% of our loans going to self-managed super funds, business owners wanting to do this. They get good advice that's all structured around a long-term plan, and they're paying down their debt with a view to having little or no debt at the time they plan to retire. And they've got this asset at the end, which is ostensibly tax-free in terms of capital and income. And it means that there's much greater support in their retirement for their income reliance, and they're much more likely to be independent and not reliant on the government system. So the commercial side stacks up exceptionally well. We'd be very surprised if the government new or present take a view that's negative towards that upon deeper analysis. But we would be supportive of greater regulation and oversight when it comes to residential SMSF lending, because there's a lot more of a speculative nature to that, and that needs to be managed.
Yeah, yeah. So coming back to ThinkTank itself, you've got 2 fixed income trusts in the commercial property space. Can you tell us a little bit about how they work and how SMSF trustees can invest in them?
Sure. Well, we have 2 funds now, Darren. One's the Income Trust and one's the High Yield Trust. They're both restricted to wholesale and sophisticated investors, so either a minimum investment of $500,000 or we need a sophisticated investor certification from an accountant to say earnings are over $250,000 or net assets are above, say, $5 million. So we are appealing to the sophisticated part of the market. That being said, even though our business has been around for 12 years and we've originated $1.5 billion of commercial property lending, we're still to develop our presence and our reputation in the investment side. So we're happy for people to start with, say, $10,000, give it a go, and what we're finding is, having been going now for almost a couple of years, is that there's a high rate of reinvestment. So people get used to the investment and the people who manage it and the information that they're receiving, the returns, and they're increasing there because of that comfort. But the Income Trust is a more conservative approach. It's around 5.4%. And it's just supported by first mortgage lending, very bank-like in what it invests in. And also then we have the High Yield Trust, which is a little bit further out. It pays around 8.4%. And these are loans that we're giving to our existing borrower base, and generally a little bit helping them achieve a little bit more than they otherwise would be the case with, say, a bank. But we can provide a second mortgage for, say, just a small top-up of, say, $50,000 if they want to borrow a little bit more to acquire a property, or, say, a GST loan where they're buying a property, particularly a self-managed super fund. If they put the money into their fund to pay for the GST, they can't get it out again. So we can provide a GST loan, and as soon as the input tax credit is processed by the ATO and they get the refund, it can repay the loan, and they're not locking up capital in the fund. So it's relatively conservative lending on our part. There's no construction or development involved, and we will be careful to stay away from that part of the market as well. So it's all very much what we've been doing for 12 years in this business and for 30 plus years in our corporate lives in commercial property finance. But the features for investors are largely around the monthly payment of interest and the capital stability that goes along with the investment, which is supported by further risk reserves that we put in place behind the actual investments, so that if there are any mispayments by borrowers or losses, then we've got a cash-backed reserve to help support those as well. So we've really built these products with the long term in mind and the safety of investors' funds to really try and give people full encouragement that their investment is being well looked after, and when they look for their money back for whatever purpose, then those funds will be readily available to them. So it's a minimum 12-month term to start with, and then it's entirely up to the investor how they go from there.
Okay, great. Well, thank you very much for your time today, Jonathan.
Great to be with you. Thanks, Darren.